From Washington, this is the Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, September 16th, and you're listening to the Macrocast brought to you by Hamilton Place Strategies and Markets Policy Partners. I'm Brennan Walsh of Markets Policy, here with my partner, John Fagan, as always. And also today well, it's a little sad because Tony's sick, but Jonathan Graffeo is joining us and filling in his place, and I'm sure he'll do a great job. This week, a new CPI report was released on Tuesday. Took the market a bit by surprise. It came in a lot hotter, not on the headline, which includes gas, which we knew was down a bunch, but the core, which cuts out both the food and energy, and it was a lot higher than the market was expecting. That freaked out the equity market and also the treasury market that the Fed was going to raise rates a lot more. In the meantime, we've also seen some other data, especially a World Bank warning of global recession as central banks continue to, maybe over tighten. We also have the Ukraine and energy markets that have been in flux, and OPEC also is trying to keep oil prices high, with Saudis saying that the market's schizophrenic after they actually cut production last week. The French also are cutting nuclear reactors, and that's unfortunately due to a pipe erosion. So the worst timing on that couldn't have been worse. But John,
got some good news. Some good news. It's Friday. It's Friday.
It's Friday.
That's the only good news.
So let me also add to the discussion this morning. The CEO of FedEx warned that the last 2 weeks, global growth has fallen off a cliff. They massively cut their guidance, and actually they took away their future guidance, saying that things are so uncertain. And I mean, FedEx, if I had to pick one company to follow as a macro indicator, it would either be Visa or MasterCard or FedEx.
Yeah, I mean, I think that's
especially after the pandemic where everything is shipped. I couldn't think of a better indicator.
Yeah, it's really the circulatory system of the global economy in such a major way. Whether you're talking about commercial shipping, whether you're talking about retail, FedEx really is that circulatory system. There's a reason people look at transports very closely. It was said that Alan Greenspan followed FedEx in particular very closely as that bellwether. The shippers are going to be feeling it on a very direct basis, very early basis. But as you said, Brendan, this week has featured, the data not really matching with where expectations were in terms of what we were supposed to see was cooling in the inflation number. We were also supposed to see, a very muted retail sales number, and we surprised higher on both of them. When you see the kind of market reaction, as you said, this virulent return of volatility in the face of some of these, this was, the very often, as a market participant, you're sort of told not to read too much into any one number. But, this is an environment where the Fed has said, we're data dependent. And, that is essentially infuses every data point, as backwards looking as it may be, with
that's a really important
total
point.
Significance to the next policy move.
That's what I was going to say, too, is we look at, there's a lot of talk as to whether the Fed's going to go up 75 or, the full 100. And looking at that retail spending number, it far outstripped the increase in inflation. So it does make you wonder whether, it'll be on the higher end of that or not.
No, I think they're setting themselves up for a massive, massive mistake. The inflation number, the CPI also is not what they're supposed to be targeting. They're supposed to be targeting the PCE. The housing component of the CPI is wonky. We know that rents are massively coming off, but more importantly, the CPI was computed on the 15th, the middle of August. It could not be a more backward-looking data point. We've had a month and now of new data points showing that the global economy is in disinflation and also teetering on recession. And because Larry Summers, they're all scared of Larry Summers. They're gonna hike 75 basis points and drive us into the global recession. This Fed could not be more pathetic, in my opinion.
That's it. Well, not to spring to their defense, they do a very tough job. But that when you do see, I think the angst that we're seeing in financial markets really is compounded by the fact that the Fed, it appears to be, taking, basically being at the mercy of events, right?
Yeah, but we have real-time data.
Right. Well, but
they're completely and utterly ignoring the actual real-time data.
Right.
And looking at stuff that happened 2 months ago.
Yes. The disconnect is disconcerting for the markets, especially as Fed officials, when you're a market participant and you see on one side the most inverted treasury yield curve in decades, in modern history, blaring a recession signal. You have the CEO of FedEx coming out and forecasting a worldwide recession, saying that economic activity deteriorated, shockingly.
It fell off a cliff 2 weeks ago.
You got warnings from U.S. Steel, Nucor, Alcoa,
all of the aluminum makers. So basically, every CEO who makes stuff that people use is saying we're going to recession.
Right.
And the Fed is worried because the shelter component of the CPI is elevated.
So yeah, market participants know who they're going to believe. And we're expecting next week the Fed to come out and sound out of touch again on the growth numbers and basically say, growth is very strong. It's very strong in the US. And I think, the markets are very, cognizant of this kind of cherry picking. To be fair, there are numbers that are strong, like the labor market data is still strong, but everybody knows that's about as lagging as you can get in terms of indicators.
I think Larry Summers says you've got to put 1 million people out of work to get inflation under control.
Fair enough. I saw the IMF.
Larry Summers is a Democrat. What became of Larry Summers?
Brendan, you make some great points, especially about listening to market participants. But how do you kind of square that with the IMF still expecting consumer prices to increase, by more than 8%? How does that factor in?
That's on a year-over-year basis. When you look at the month-over-month, we just have to get the pigs in the python. So that's all baked. When you look at actually what's happening on a month-to-month basis, prices are coming down massively.
This is one of the
car prices dropped the most they've ever dropped in the month of August. They were down 4%. So the problems that we had with the pandemic and supply chain issues are basically being fixed. And also, we did print a lot of money and things like that. That stimulus is coming out of the system, and we're seeing a normalization. And so in February of 2022, you could have taken out a 2.25% 30-year mortgage. It's 6% right now. The housing market is in a free fall, and the Fed is only paying attention to what the weird rental component in the CPI is.
Yeah, Jonathan, I think you make a really good point. You said CPI is 8%, and that it's 8.3%, and that is definitely true. And as Brendan said, the Fed has kind of lost messaging discipline on inflation, right? They're just attacking whatever inflation number. Any number is as important as any other number, but that's not traditionally how it has worked. The Fed is typically focused on the core PCE price index, which is below 5%. It's looked a whole lot better than the others, but the Fed has let its, for perhaps for messaging reasons, sort of let the market focus on whatever inflation is out there. And of course,
John,
everybody's focused on.
But I slightly disagree with you. I'm going to take it even further. The Fed usually doesn't even care what PCE or CPI is. They care about what inflation expectations are.
Right. And
guess what inflation expectations are showing?
Yeah. The long-term New York Fed one was what? Drum roll, please. It was 2% in the 2%. Last survey.
and all market gauged inflation expectations are back to where we were pre-pandemic.
That's right. The Treasury.
They're worried. They're not worried about the market. They're worried about Larry Summers being mean to them.
Well, I think you mentioned the market, and I think that is very interesting. It was Minneapolis Fed President Kashkari kind of, said the quiet part out loud, as the kids say these days, when he said, we were at the Fed, we were quite chagrined to see equity markets react positively to the July meeting and go up after that. And, I think that is an admission, I think, that makes one wonder, exactly how are you making policy at the Fed level? The reality
the equity
is,
market is really small, actually.
Yeah,
and if you're trying to drive down equity prices as monetary policy and not paying attention to your actual mandate is inflation and employment.
That's right. It's policy.
You lost narrative, and you shouldn't.
Right. Well, that's policy malpractice. But I think the reality is the Fed for so long has conflated financial conditions with the S&P 500, and so to tighten financial conditions, the S&P 500 cannot go up. And I think that this is a formulation that is prone to bringing you to the wrong answer as a policymaker. They have a lot of inputs, and I think it's we'll see what next week the statement brings. But the expectation is that they're either going to go 75 basis points or even 100. When pretty much, a lot of their peer central banks are now going the other way. So we heard
that's a really important point.
So we heard it from the Reserve Bank of Australia, Governor Lowe, has their unfailingly honest central bank came out and said, the time for jumbo hikes is pretty much over. We've come a long way really fast, and now we're gonna continue tightening, but we're gonna do it at a more judicious pace. We're focused on the growth risks as well. This coming into a more balanced kind of dynamic, and we want to achieve a soft landing. And to do that, modulating our tightening makes a lot of sense. The European Central Bank, one of their key people, said this very same thing. They did 75 basis points last week, and the commentary earlier this week. Obviously, the ECB speaks with a lot of voices, but this was
only a few matter though.
The chief economist suggesting that that 75 basis points was kind of a one-off, and the next moves would be more measured. We saw that the retail sales number was so bad. The Bank of England was supposed to go 75 basis points next week. Futures reset very swiftly to 50 after that horrible retail sales number we got this morning. And you go around the rest of the world, and there's a notable downshift in a lot of the, if
monetary
not abandonment of tightening, just downshift.
And apparently our central bankers have completely and utterly forgotten that.
Well, the issue is then if you have the Fed still storming off in sort of 75 basis points now, and maybe the next meeting and maybe the next meeting after that, we're already seeing the pound is now at a 37-year low. Right. The euro is below parity.
This is a really important point. And I think that's what's freaking the World Bank out.
The Fed is the central bank of the entire world. And there's a component of thinking in there that has to be taken into account, because if monetary policy continues to diverge, if you get this, out of necessity, really a realistic assessment of what they're facing in terms of stagflation in Europe, the UK, Australia, and some other places, a downshift in their tightening cycle. This is and the Fed keeps forging ahead. That's a recipe for further dollar strength when these currencies are already at extremes. Look at the yen just getting pummeled, and you can lay it at the doorstep of the Bank of Japan, but it takes two to tango in these things, and so it'll be interesting to see if that that's something that the Fed would never say out loud, but it was really one of the animating factors. If you think way back to 2016, when we were having this global deflationary scare, and at the time it was Treasury Secretary. it was Fed Chair Yellen, and she went to Shanghai for a G20 meeting, and there are all these pictures of her like looking really concerned, and they came back, and there was a coordinated at that point it was a coordinated easing was what was deemed to be true. But again, it was the dollar sort of riding roughshod over all global currencies, and that was one of the things that really put paid to the tightening cycle that Yellen had initiated at that point.
Yeah, and if you look at a chart where the dollar wouldn't even show up on the chart compared to how strong it is today.
Well, I mean, we've talked about the slowdown and the downside risk here, but what about like the Inflation Reduction Act and the spending? We talked earlier about COVID stimulus having worked its way through the economy, so that's behind us. But what about all the spending that is still coming out of DC? Do you guys just discount that?
So there's two sides to that, which is very interesting. The COVID spending went out the door immediately, so that was inflationary. Pretty much everything else that the Biden administration has passed, whether you agree with or not, is very slow out the door. So it's not particularly inflationary because it's going to take 10 years for this money to get out the door. And also on the flip side, I mean, they called it the Inflation Reduction Act. It's not going to really reduce inflation more particularly inflate it.
Sell that one on the campaign.
Gas prices were coming off, so you took a political win on that front. It really was an environmental bill. But I don't think that any of the spending that they've done is going to have any effect on what's going on in the economy for the next 6 to 12 months. But what is borrowing costs on $30 trillion in debt now equals $300 billion a year because the Fed has raised rates. And that's something that hasn't really been, hugely talked about. So we have to pay more to borrow money. And that is massively increasing our debt. $300 billion, an extra $300 billion is what, half of the military budget and things like that.
Yeah, I worked on the appropriations committee before I came to HPS, and that if you look at just that big picture pie chart of how much interest on the debt takes up of our total spending, it's very alarming. And
and not that the Fed should make decisions based on that, but it is just a reality,
Yeah, next week is real central bank of Palooza. We've got the Fed, we've got the Bank of England, we've got the Bank of Japan. I think we've got Turkey as well.
Turkey. Turkey's always fun because it's such a pandemonium over there. Yeah.
Oh yeah, and I mean the sentiment could scarcely be more negative coming into this in terms of market psychology. I think next week is going to be one of those weeks that we look back on, and write thesis about that. It either it could be a huge changing tone, or it could be what proves to be a large monetary policy mistake. But let's take a break here, and we've talked a lot about what's going on here in the United States, but let's talk a little bit about what's going on abroad for our next segment.
HPS is looking for full-time public affairs associates and analysts. We're seeking entry-level associates and analysts to join our dynamic team. Associates have immediate client exposure and opportunities for professional development while working in a fun, fast-paced, and challenging environment. Applications are open now. Recent graduates or applicants with up to 3 years of postgraduate work experience are encouraged to apply. Learn more and stay up to date on our openings at hamiltonplaystrategies.com/careers.
Welcome back to the HPS Macrocast. John, so we've talked a lot about what's going on here in the United States, but Europe has an even more daunting task ahead of them, the ECB and the BOE, especially with the war in Ukraine. You have energy issues. What are you seeing on that front?
Yeah, I mean the situation there is obviously acute and has forced the hand of policymakers into some pretty extreme positions, intervening in these markets. And when you see the discussions about price caps, you get the UK. We talked a little bit about this last week. The sort of cognitive dissonance that occurs when you have an acolyte of Margaret Thatcher on her third day at 10 Downing Street instituting an energy price cap for 2 years, which is which is going to cost an absolute fortune.
Yeah.
And you just that
that was the best. So when the announcement came out, I was watching the various CNBCs and Bloombergs, and everyone's like, how are they going to pay for this? And then it took them like 10 minutes, and they were like, oh, the government's just going to pay for it.
Yeah, Europe, I mean, that's even more radical than what they're doing in Europe. Europe has maybe worse options and less cohesiveness, but the amount of consensus on how to go forward and try to come up with some way to cap prices in areas where there aren't gas. We saw that. Gas prices and energy prices in Germany and in the regional natural gas prices have come down a lot. Intervention tends to work in a short term. Yeah. That's the sort of discussion. The thumbnail is intervention doesn't work, but very often intervention works in a very short kind of time span. Yeah. Or it works kind of when it's in place, but there's always that cliff, right? That's how, when you...
Well, we know WTI can't go below $80 because the Biden administration announced that's what they're going to buy it at.
The beauty of it, John, is it's somebody else's problem in 2 years.
From the political standpoint, that's right. And I think to give them a little bit even more, like, honestly, they're what kind of choice were they given? I mean, it was essentially like, let all of your companies and households go bankrupt. You have so what else are you going to do? And that's kind of like the desperation level that they're facing. There's a discussion about, the degree to which they can cap Russian oil prices using leverage through the shipping and the insurance arrangements.
And I think it can work a little bit. And you might as well try, but it's not going to massively.
I saw this morning where Germany took over the Rosneft subsidiary. That was interesting.
Oh yeah, the gloves have been dropped now, and it's just a slugfest at this point. And the Russians, when they said, no longer a pretense of like technical fixes in Nord Stream pipeline. It's like, no, guys, we're just kidding about that anyway. We are not turning the taps on until you roll sanctions off. And so the mask really dropped right there. And it's pretty clear that. And we had a really interesting call with an energy analyst, a notable energy analyst, Paul Sankey. That you can find that on our website at marketspolicy.com. Link to the replay of that. Couldn't be more insightful and timely. And he was talking about just how structural these kind of problems might end up being. The near-term fixes and to try to keep the wolf from the door in a very tough winter. But at the end of it, is there any supply that's kind of riding to the rescue? And it certainly doesn't look like it in terms of, whether you're talking about natural gas, whether you're talking about oil. But, at the same time, this is the winter where Putin has to apply maximum pressure, because if you get through the winter without somebody in the, in the NATO alliance cracking, and they make it out the other side, well, then Russia's leverage from energy as a weapon really is diminished.
And I think that's really an interesting point, and maybe even to take it deeper, the war and then the energy crisis has very much united Europe, and for the first time ever, we see a fiscal unity, and they're actually borrowing money together to pay for things. So I suppose somewhat ironically, Putin's efforts in Ukraine has very much unified both the NATO and the EU experiment, and accelerated it probably faster than anyone could have ever imagined.
Do you think it holds?
Yeah, I think we've gone so far that you're not going back. Once you start issuing debt together, I think issuing debt is fun.
That's the point of no return at that point.
You borrow the money, you have to pay it back later, but you get the money right away and you can spend it. So, I think the EU fiscal coordination is begun, and I think it's gonna. I don't think it'll reach the levels that we have in the United States, but it's not going anywhere.
Well, I mean, you look back at the way that the United States was formed, and you look at what's happening in Europe right now, and it's a situation that is kind of akin to that. We've got to hang together, or we're all going to hang separate. And whether it's geostrategically, whether it's a united front on the energy question, and that sort of thing. These are, we're getting toward real existential kind of risks for the governments when they look at the kind of dynamics that they're facing, plus the Russian threat. And we saw Xi Jinping in Russia making common cause again with Putin, who's obviously just an international criminal at this point. And it was President Xi's first trip outside of China. Very, very symbolic, and not in a very positive way for the Western world. So, I think that the centripetal forces that tended to blow Europe apart are, being overbalanced by, Brexit was very galvanizing. Let's let the the Brits go, and it brought us together. And then COVID, of course, that fiscalization, that federalization of debt to the degree that it happened there, consensus building and that sort of stuff. And now this crisis, it's a really challenging environment, but we do think it brings Europe together. There's also no Angela Merkel, right, who is a very local, take care of Germany first kind of politician. Mm-hmm. And when you don't have like big figures leading and France, that's not going to be the leadership of Europe at this point either. And Draghi's out in Italy. And so the poles of power just go toward Brussels by default. And that's, I think, that the way things are going to go from here.
Yeah, it's kind of the way that we came together as a country. It was really the world wars that brought us together, especially on the debt front.
It was like the French and Indian War, right?
Yeah, that was the first one. But my point is, always big, basically wars that unite places. And Europe was a bunch of countries, and we were a bunch of states. We still are a bunch of states.
Yeah, in terms of the geostrategic picture, one of the players obviously is OPEC. OPEC has been a very challenging entity for the Biden administration to deal with. No mm-hmm. love lost there. The Biden administration basically got the cold shoulder. Biden himself got, not what they got a concession out of OPEC, right? They pulled forward some of that supply, but it was that. No,
they just took it back last week.
Took it back, right? And with prices plunging into the mid 90s for Brent, that was too low for OPEC. And so on Tuesday, they're out there on the same day as the inflation number. OPEC is jawboning oil prices higher. And the West Wing must have just been like, hey, thanks, jerk. Yeah, appreciate it. Thanks. I'm sure it's no coincidence of the timing of this inflation number and getting OPEC twisting the knife. This is not an easy solution, and clearly, the dynamic has to be for structurally higher oil prices and energy prices, and there's no quick fix. I guess the quick fix is demand destruction. The whole world plunges into a worldwide recession.
Yeah,
we don't.
That's what the market is trading.
You don't have a job. You don't have to commute. Yeah, it's not a pretty picture. But I guess in terms of if we're trying to cobble together some good news, it's in addition to It's Friday, we've got it looks like the U.S. rail strike has been averted. What's the latest status? Have they got a deal finalized, or are we still twisting in the wind?
I think the vote with the unions was supposed to be today. Have you been following, Jonathan?
No, I think that's right. I've not seen anything beyond that at this point.
Yeah, but that would be a terrible own goal on our part.
If the Biden
it's kind of ironic because Joe Biden,
the union guy,
he was the president that saw the global our economy go down because of a rail strike.
Yeah.
Well, I guess maybe taking it back home, Biden's had a pretty good month or so, and his approval ratings came out yesterday. It's back up to 45%. What are you thinking about the midterm elections? Things are looking a little better for the Democrats than certainly the expectations were, 2 months ago.
Yeah, a lot better. A lot better. I think they had, obviously a bunch of successes in big legislative wins. And it looked like inflation was starting to come under control with gas prices dropping. That I think was probably the main thing for most people who were feeling so much pain at the pump and at the grocery store. We'll see how the latest numbers, affect that 45, whether it comes back down or not. Certainly in the Senate, they are, most prognosticators have switched it back to either toss up or leans, likely to remain in Democrat hands.
Yeah, I did a call 6 months ago with one of my good friends, Ed Hill, who always has a good sense of things. He doesn't get too caught up one way or the other. And on the House, he was saying, you can kind of look at the macro indicators on the House, but he's like, the Senate's quirky, and he's like, I don't know who's running, so I can't tell you who's going to win the Senate. Now we know who's running, and it's kind of proven to be a little bit of a benefit to the Democrats.
Say that's been certainly the story up here is the infighting between McConnell and Rick Scott about candidate choice.
Yeah,
but Scott has tended to side more with the Trump favorite candidates, and McConnell. McConnell's been burned several times by bad candidates who could have won easily won races and didn't do it because they stepped in, they stepped in piles that's just such unforced errors.
John and I are from Massachusetts, and the two most popular governors in America aren't going to be governors anymore. Sununu in New Hampshire and the governor of Massachusetts, who didn't even want to run because he knew he was going to lose he wasn't going to win his primary against a Trump candidate.
Yeah, that's exactly right. I think the House districts by nature are much more, you're not dealing as much with the moderates.
Exactly. Yeah.
And so it kind of naturally sorts out that way in the House. But the Senate, that's where the ball game is right now, and it's looking better for Democrats.
Well, let's say
again though, it's like if inflation continues to be a problem, that could completely wash away their gains.
What do you think if the base case occurs and we do get, let's say, Republican House, Democrat Senate? What kind of legislative actions, if any, do you think can get done? What do you think are the priorities, assuming there's divided or at least some degree of gridlock here? What do you think the energies of the White House are going to be turned toward, and if there's any sort of legislative path forward for much of anything?
I don't know if there's much of a legislative path forward for anything, to be honest. Having just left there over, just a year ago, the gridlock in the Senate and the partisanship is at all-time highs. It's always been high, but it's extreme right now. And there's just, what are the incentives for them, to coordinate? What are the policies that those?
Yeah, which policy could possibly get?
Yeah,
Republican vote, or maybe 15 Republican votes.
Yeah, they have no incentive to go there. They've gotten Republicans on, over the past couple of years, they've gotten, some bipartisanship on some measures, not a whole lot. But the thing about it is going into a presidential election year, I mean, everything pretty much stops starting next year.
Normally it stops. You would also have a very, very divided.
There's zero, incentive to cooperate. And so kind of, I think one of the implications of that is you start looking to agencies and seeing what they can come out with, or executive orders.
Yep.
And Obama famously talked about, being able to pick up the phone and a pen and produce executive orders to still, try and gain some wins in certain places. But I think you can see agencies like the CFPB, possibly become more aggressive.
Well, we've seen the SEC really want crypto under its domain, and we saw the Biden administration kind of support him on that front today.
Yeah, crypto might be something where they've got a bipartisan bill, and the agencies are busily jockeying for position on that, and it'll be interesting to see if Congress has anything to say about it. But I mean, they're definitely trying.
Yeah, I think that's right. There definitely is some bipartisanship, but I still question just how many members, like across the board, are really engaged and really know the issue. It just doesn't feel like it's bipartisanship is important, especially when the Senate is that evenly divided. But you've got to have critical mass too, and I don't.
Yeah,
maybe
it's a quirky
just
thing. Like it's not really a Democrat or Republican thing. It's just crypto.
Yeah, I think they're still trying to get their arms around it, to be quite honest with you.
One of the other things is the U.S.-China. Apparently there's a sense that the Biden administration has kind of put off their review of the Trump era tariffs and that sort of thing. But, the signals are they just tightened their technology, the technology export curbs. And so, the directional winds seem to be blowing still in a very confrontational direction and deepening the rift.
But that's a great question.
But they could still tweak some stuff, like some of the stuff that's like not strategic. There's an argument, I think, to maybe review that. But on the other hand, anything that you peel off and give to China just is leverage that you've lost. If you don't get anything in return.
What's the sense that so we've kind of, because we saw the transition from Obama to Trump to Biden, and it kind of became clear that we don't have competing policies, Democrat or Republican, on the China front. We're pretty unified on that side. How we implement it is a little different. But would you agree with that? Is that what you saw up there on the Hill?
It is, and I mean, you have to think it. Regardless of whether Democrats across the board agreed with Trump's ratcheting up politically, you ratchet back against China, and
it's a loser.
Nobody wants to be put in that position. And I think a lot of them, you have, for the longest time, you had senators from like the Rust Belt states who would argue for, Democratic senators who would argue for those things. So there was. Not only would not want to walk it back and have to answer for it politically, but a lot of them agreed with, maybe not every single thing, but, putting more pressure on China in general, they already agreed with. So.
Yeah. So I guess there might be some sort of small bills that you could do, reshoring, strategic things and whatnot. But basically, the next 2.5 years are going to be pretty quiet on the legislative front, either way, no matter what happens.
Yeah, I mean, it'll be you see them right now trying to, avert a government shutdown. I don't think there will be one, but those
are always fun.
That's the kind of stuff that happens over the next years. You punt a CR 2 more months, and then come back in December. It's supposed to have been time to negotiate it, and that nothing moves. So you punt it to March. And before you know it, you're already at the end of the fiscal year anyway.
Yeah. Well, in DC, government shutdowns are very stimulative because all the 20-year-olds are out drinking all day at the bar.
Yeah, that's fair. But yeah, it's so hard to even get the government funded.
I know. Yeah.
In this environment, and especially when you're going into a presidential election.
Well, this was a lot of fun, Jonathan. Thanks for joining us. John, what do we have? We addressed that we have some big central bank meetings, but anything on the data front that could sway them one way or the other?
Let's see. The U.S. data is relatively light. We've got global purchasing managers indexes. That's the big, those are the big things on the global scene for growth indicators next week. So preliminary for September. So we'll get a look at those.
It's probably not going to be great, but it's not going to massively swing monetary policy one way or the other. Well, go out, enjoy this lovely weather we have, and we'll see you next week. Thanks so much.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.